The question we're looking at today is, what do most startups not know when it comes to raising VC investment? You see, in my role as director of Engenesis Ventures, we see so many startups, sometimes up to 300 applications per month me and my team need to process, many of them going to one-on-one interviews. And we just keep seeing these patterns over and over again when it comes to people understanding VC investment. So in this video, I'm going to go through 4 sections. Number 1, what most startup founders misunderstand about VC investment. Number 2, transforming your awareness in the venture and investment game. Number 3, how to reverse engineer how VCs think. And number 4, how to understand startup criteria for VC investment. In other words, how you can set up your startup for successful investment yourself. For those of you who are new, my name is Ari Achidasi and I'm the director of Engenesis Ventures. And as a venture builder based out of Sydney, Australia, we've now done interviews or due diligence with over 2,400 companies, and our team has directly worked with over 800 companies. So you can imagine the patterns of success and failure that we see over and over again, and we hope to share some of those patterns with you here today. So let me dive straight into number 1. What most startup founders misunderstand about VC investment. So one thing that we see for the majority of beginners or early stage startups, but sometimes people who have been in the game for even a long time, they misunderstand venture capital as if it is something like winning the lottery, okay? It is not. Now, I can completely understand why startup founders would think this, because if you go to any media outlet, if you go to a lot of these articles online when startups raise funds, what happens? A lot of the times they're on stage, they're shaking hands with the investors, or sometimes they've even got those big checks. So it's confusing. The way the article is written is as if they've just won the lottery. They've got that money in the bank, $1 million, $10 million, and then it's as if their life is so easy and their company is already a success. Now let me go to the extreme and share with you what it looks like if you take this type of approach, if this is the paradigm in how you are thinking about investor money. Let's look at the example of Sam Bankman-Fried. Sam Bankman-Fried was a CEO and the founder of FTX, and it was a big crypto exchange type of operation. He was accused of swindling FTX customers out of $10 billion. So not only was he taking investor money, but even people putting their money into the exchange as well. Now here's where things get pretty interesting. He was taking those stolen funds. He had this luxury, exorbitant lifestyle. In other words, he was taking all of this money and just spending it. He was doing political contributions, A-list celebrity endorsements. He had a $200 million property in the Bahamas. So if you are thinking that you can go and raise funds and then have this type of lifestyle, from those funds, this is one of the things that will put you in jail, right? I'm no lawyer, but it's very likely that you will go to jail if you do these types of things. So instead of looking at investment and fundraising as if it's such a big part of your journey, know that it's just a stepping stone. And here's what we would invite you to do instead. You want to look at it as the start of the next journey, because once that $1 million is in your bank, whether it's 1 million, $500,000, 5 million, whatever, once you have that $1 million in your bank, your job as a founding team is to take that 1 million and turn it into 2 million, turn it into 5, turn it even into 10. And this is the more challenging thing to do. I know that raising funds can be extremely difficult. But what's even more difficult is turning those funds that you've raised into even more. And that's where the role of the entrepreneur truly comes to play. Now, let me be quite real with you. If you are not thinking that that's what you want to do with the investment, I literally would say stop your journey now. It's already going to be so difficult to go through that whole process. The hard reality of the matter is that if you are not looking at your investment this way, then you're most likely going to fall into the failure statistics of the startups that don't return money back to investors. One particular study which said as much as 75% of VC investments don't give back $1 to the VC above and beyond their original capital. Okay, that's 3 out of 4 investments not making any money. It was better to leave that money sitting in the bank. Let's look at a quick second data point. So this is a Financial Times article and it's showing a graph of the amount of return. So some will give 20x return. Some startups will give 20x return of the funds given. $1 million turns into 20 or more. Okay, $1 million gives $10 to $20 million back, one gives 5 to 10, and so on. So as you can see, it's about, I mean, if you add these two together, roughly speaking, 80% is going to give back something like 1 to 3x on the return. Okay, which is quite mild when you're just looking at the amount of risk the investor is taking on. Now, the reason I bring this up, because I'm going to go into this later about what it means to then start reverse engineering how VCs think for your benefit as a startup. We want to pay attention to what's going on up here. Okay, so VCs have a very small number of ventures who get a disproportionately high return, and that is the reason they are investing anyway. This is one of the things that I want you to really understand, especially if you want to be in this game. So now that we've gone through what most startups misunderstand about raising funds from VCs, let's now go into transforming your awareness in the venture investment game. Because, and this is something that is actually in the Being framework, the framework that looks at your effectiveness, your leadership as a human being. And what we look at is, if you want to be effective at something, you first need to be aware of it. You need to have the inner understandings of how that thing works. So let's now look into this if you are a startup who wants to raise funds from a VC, or actually any investor in a more broader sense. In our experience, and sometimes we've had hundreds of applications from founders across the world, we're going through all of the interviews and we just keep seeing this pattern over and over again, that many people simply have not put themselves in the investor's shoes and really understood what they're thinking, what drives them. And a lot of this information is easily available on the internet. I in fact invite you to go through and look at different articles from the VC's point of view. But in reality, we find a lot of startup founding teams, they just don't do it. Okay, so let me go through a bit of a broad stroke view to save you a lot of time from scouring the internet. Let me give you a bit of a summary of what is it that you want to be aware of if you want to go in and win at this game. So one of the patterns that we kept seeing over and over again, people like to jump in, they like to create their pitch deck and just keep spamming lots of investors, right? Just as many possible interviews or conversations with investors that they can get. They just want to chuck themselves at it as if it's just a numbers game. Now, definitely there is a small component which is a numbers game, but there's much more to the picture. So when we put ourselves in investors' shoes, the first thing we want to look at, especially from their title as an investor, they want to invest their money and get a return on that money. Okay, so they want to put in that money and at some point later, take it out, and that money went times 2, times 3, times 4, times 10, times 20. And in the process of them investing that money and getting the return, they also hope that that money was put to really good use. Maybe it had a positive impact on society. It helped create jobs, all of these other additional benefits. Okay, so we talked about how an investor wants return on their investment. I don't think that's going to be new to the majority of you. But then you want to look at the VC and what their model is, because they are a business and they have a business model. Okay, so what happens is they or their team, they go around, they call all of these other people who are investors and they say, guys, why don't you come and tip your money into us? Okay, we're going to go and do all of the hard work for you. So first and foremost, you're obviously going to invest in us if you want to invest in startups. Now, the lucrative thing with startups is, I mean, think about Peter Thiel investing into Facebook. Okay, 500K. Think about Jason Calacanis investing into Uber. So there are all of these stories of especially the big companies. Many of them are trillion-dollar companies now. Another good example are all of the different people who invested into Amazon in the early days. Okay, so the big lucrative win from the whole game of startups is that you can back something that becomes a huge company with extraordinary returns. So the role of the VC is getting that investor to go, hey guys, why not come and invest in startups? But instead of doing it all yourself, what if we did the hard work for you? What if we went and we filtered through hundreds and hundreds of startups? What if we found the top 1% of them? We put them into, this portfolio. We then gave them the money and then we supported them to grow. So that's what the VC is doing. Oh, and one more thing, they are coming up with their own success formula, going, this is our hypothesis. what startups you should invest in, why we should invest in those, and that is what is going to make up my fund. So you want to put yourself in the seat of the VC, thinking as an entrepreneur. They went and they sold these types of slots or positions to come and invest in their fund. Some of those VC funds are something like $10 million all the way up to multi-billion-dollar VC funds. So let's now go into the business model of those VCs and how they relate to those investors. This is from a Harvard Business Review article about venture capitalists get paid well to lose money. Okay, and in that article, it talks about how it's generally a 2% annual fee on the committed capital. So what does that mean? It means that if $100 million is invested into that VC, they are going to charge $2 million every single year just to run the VC. Okay, so that means paying all the staff, doing all of the interviews, having everything operating day to day, the lights being on and so on. So even if they don't make a return, they are making that money annually. And for example, if they are operating for 10 years as planned, then they would be taking 2%, then 2%, 2% over that amount of time. And then there's a 20% carry on any investment profits. So there's that 2%, right? Again, in this example, $2 million each year. And then a 20% carry. That 20% carry means if they actually make profits from those investments, they are taking 20% of that upside, and then the other 80% goes to investors. My intention is to give you a basic background and infrastructure to how VCs work, right? A lot of the times those numbers will be tweaked up and down, but in the end of the day, the business model of a VC is this. They are going to those investors, raising that funds, getting paid a fee to manage the whole thing, and then getting an upside if they go well. So let's now go into section 3. How can we reverse engineer how VCs think so that you can actually use that as a startup? So in a moment, I want to go through with you how VCs are thinking, what they're looking for so that you can use it to your advantage. But let me first share my actual experience with other VCs. I remember one particular conversation. You see, at that point early on in my career, I remember thinking, oh, VCs are so amazing. They're going in, they're giving this free money to all of these startups, and then they really want to support them to grow. And there I was sitting with a VC in their office. We were discussing lots of different things about startups and portfolios. And then he was going, oh, we just invested in 20 different startup companies in that portfolio. And then I said, okay, great. So what do you do with them now? Do you sit with them weekly? How do you support them? And he goes, well, actually, we typically leave them for about 3 years. And I just stopped. I went, what do you mean? Like, you've already invested money in them. Wouldn't you want to go and support them? He went, no, we actually want to leave them, see which ones are not serious, and some of them are going to fail. And then the ones that are doing well still in about 3 years, then we start talking to them. So firstly, it was a bit of a mind blow for me at that point of time, going like, oh wow, they actually don't put as much in as I thought. But then secondly, I said, how many typically then make it through? And then he said somewhere between 1 to 3 out of 20. Okay, so they expect somewhere between 17 to 19 startups to fail, and they're so okay with that. All right. Now, this is not something to go, oh, VCs are bad and they shouldn't exist. No, definitely their existence has a huge positive impact on startups succeeding across the world, right? What this is about is supporting and empowering you to deeply understand how they think and how they work so that you can use it to your advantage and understand the game better. And so as a side note, it was experiences like these when we learned about what the VC model consisted of. At Engenesis Ventures, we decided to be a venture builder where we actually focus on adding value and adding substantial layers to the venture, to the startup, and supporting them grow in a far more interactive and intimate way. So with that being said, I want you to think about what that means and to go through with this new lens and look at some of the activities that you probably already know out in the VC space, out in the startup and investor ecosystem spaces. So why a lot of VCs run different events and attracting all of these startups, they are doing a huge filtration process. They want to sort through hundreds and hundreds of startups, and they want to find the few that really will work for them. In addition, how the VC is looking at the equation is they are not looking at just one startup going, I want to find the one perfect startup. They have a portfolio to fill, okay? And so they are looking for the right number of startups to fit that portfolio so that it's well-rounded. So when you look at it from that position, you don't look at it as, am I just a good startup, right? Can I get better and better? You also want to look at how well you match the portfolio of that VC. Okay, how well do you click in with their goals, with their objectives? How well do you click in with the other investments they've already made so that it's well-rounded and it helps them win? If they win, their investors win, and then they also get that big paycheck at the end of the day. Now that we know this, let's look at how to understand the startup criteria for VCs and how you can understand this so it can go to your success as a founding team. The first thing I want to look at is I want to tell you that it does matter how much you're going to scale. Okay, some people like to use the focal point of your total addressable market. Now, I'm not going to go through all of the technicalities of total addressable market. That's not the thing. I want to give this in a very foundational way. I want you to really understand this. In the end of the day, the VC wants to know that if they invest in you, you have a very high potential of massive success. So again, let's put our mind in the seat of the VC. And what I want you to do is imagine that you've got all of these commitments from investors to come into your VC fund. You need to give them a return. And then you're compiling, sometimes it's 10, 20 or more different ventures. And you want to make sure that all of them have the potential to go to this type of $1 billion plus status. Because it's going to be one or two of them that's going to really make your return and make this all worth it. Okay? So with that in mind, when you go and look at any single venture, that venture has to be able to go so well, right? If the upside is blocked for some reason, then that's going to be one of the biggest issues. And this is one of the biggest criteria that VCs have. And it's not even something that they can just have a preference to avoid. If they don't do that, the mathematics just don't stack up. And so this is what relates to that total addressable market or total obtainable market. So again, we're not going to go through all of the nitty-gritty, but I want you to understand the overarching idea. So this is an article from Forbes pitching a VC how to size the market opportunity. And in this article, a partner from a VC is actually speaking and being interviewed. And they say that your total obtainable market should range from $500 million to $1 billion. So what that means is that the total amount of customers that you could possibly obtain, if you had a magic wand and you were able to influence all of your customers to say yes, all of your marketing and sales strategies work perfectly, it should be between $500 million to $1 billion, right? And why this is important is because we know that you are going to get just a portion of that total market. Now, to compare this with something else, to give you a better idea, imagine that you did all of the calculations and you realize that 100% of your customers was only $500,000. Okay, that's not the amount of customers you have. That is if you had that magic wand and you got all the customers in the world to say yes, you only made $500,000. In reality, you're not going to be able to make all of that money. You're only going to be able to get a portion of customers, maybe 100,000 or 50,000. But if we look at that total obtainable market, okay, if we look at the total market that you can target, that is a very simple comparison for a VC to do. And if that's too low, even if you're amazing at execution, you're amazing at building product, and your team is just out of this world, that market is going to be a ceiling that limits you, Okay, now there are some extremely minor exceptions to this. For example, if you can show that you can get this market and then you can grow another market and all of this, then that's fantastic, and if that's you, go for it, right? But the vast majority of people, what we see when we are processing through hundreds of different applications of startup founders, the common pattern is actually that people just miss this, right? They haven't done the research and the calculations to know, if I had 100% of customers around the world, then what would be the total obtainable market? So it goes without saying, if you want to reach VCs, then you want to really make sure you have a high total addressable market, total obtainable market. You want to know that there is more than enough pie out there for you to go and get a slice of. And this brings me to a related point about how you are looking at your scalability on an international level. So there are a few cases, or a small portion of cases, where sometimes 1 or 2 countries are more than enough to reach that very high total addressable or total obtainable market, right? But in many cases, if you don't internationalize what you're doing, there's no way you're ever going to hit those levels of revenue, those levels of customers. And VCs know this. So if you're going in there going, oh, we just want to stay, obviously we're based in Australia. When we hear people going, oh, we just want to stay in Australia and that's all we're thinking of, we already know that they are going to struggle. If they are only dreaming about, getting across Australia, then it's going to be even harder for them to think about going across many, many countries. Some of the startups that we've grown in our portfolio went from nothing to 39 countries across the world, serving all of these customers in different locations. So ultimately, it's going to come down to the numbers. You want to be aware that they're going to play a big role if you want to raise VC funds. So definitely go and check those before you go and start approaching those potential investors. Another thing here is the VCs are going to have criteria, and they are going to want to filter as much as possible the startups that they know won't fit in their portfolio. And what we find is a lot of people go, oh, if the VC just, if they accepted this type of startup, or if they were a bit more lenient, then I could come in and I could take their money, right? But when you look at it from a VC's point of view, all they are doing is trying to manage the huge workload of their team. So for example, if you go to a lot of VC websites, they're going to have a little box, okay? And one of the boxes is, what level of revenue are you at right now, okay? Are you at 5K monthly recurring revenue, 10K, 100K, or so on? And some of them don't even allow you to submit the form unless you have, for example, 10K monthly recurring revenue. So what I would invite you as a startup founding team to look at is, from their point of view, they are simply doing this for practicality. They would rather have all of these startups go and try their best. Many of them are going to die off and not make it, but some of them are going to successfully hit, that 5K MRR, 10K MRR, or so on. And that's going to be the easy way they qualify people to sit and talk to then build that portfolio. So rather than just looking at it as, I hope that the VC would change their criteria, by deeply looking at and understanding that VC, even getting a level of intimacy and knowledge about them, so that you're going, oh, this VC is building that type of portfolio. Would that make sense for my company? Okay. If you look at this as a two-way, match, it makes it far easier for you to understand whether a VC would likely take you on or not. Now at Engenesis Ventures, this is something we really believe in, because we don't believe in going and raising funds just for the sake of it. In the end of the day, if you are a startup entrepreneur, you are here to build a high value company that's serving society, that's solving problems. I mean, this is what we want. So instead of looking at these VC funding criteria as a blockage, look at it at a milestone for you to hit. For you to go and do all of your homework, build the value of your company, the substance in your company to that level, so that you can partner with those VCs and then you can take it to the next level. So now, with all this being said, I want to say one final thing that's quite important. Because while we've been painting the picture of VCs in general, number one, they're all different, right? Someone that is building a $10 million VC, maybe they really want to get involved and do smaller investments, and they're going to be thinking very differently to a $2 billion VC. So you really want to know that there's a lot of different VCs out there, and they're going to think differently. On top of that, I hope that you can see that VC investment is only one option, and by better understanding it, you know if it's for you or not. You see, there are some cases where you may not want to take on the VC funding because it comes with them being able to make certain decisions in your business, or you have to go and match their desired growth trajectory with their whole portfolio, different things like this. So it's not necessarily good or bad, it's more about you understanding it so you can make a conscious and aware decision strategically what fits with what you are doing and why you are doing it. If you got value from this, make sure you subscribe for upcoming videos and leave a comment to let me know what really resonated with you or where you're getting stuck or potentially ideas for future videos. Outside of that, here's to growing leaner, faster, and with less risk. I'll see you next time.